UK economic data has been coming in on the upside recently, but does this all mean that the UK economy is on the mend? Well, I've been speaking to Mike Van Dulken from Accendo Markets. We've seen a really interesting week for UK data. We've seen much better than expected GDP. We're seeing inflation ease. We're seeing really good PMI data. We've also seen construction output improving. What does this all mean? Is it just the case of a coincidence, or is this a start, do you think, of a concerted recovery in the UK economy?
Well, firstly, it's a good sign that we're having several components, if not all of them, improving at the same time. If we were just seeing the services sector running away and the other two lagging, there might be a few too many questions about whether this is a genuine recovery. But the fact that all the components of GDP have improved so strongly, and then with the PMI data's knocking into the high 50s in some cases, especially, don't forget, services is such a heavy component of the UK GDP. If that's doing very well, it is a good sign. As you say, inflation cooling is nice to see. That'll help with consumer sentiment, whether you can afford to go and buy whatever it is. House prices still rising. The banks seem to be lending a little bit more. There seem to be a lot of things happening, and it's good timing as we move into, solidly into the second half of the year, and it bodes well for the year 2013. I mean, I think I saw already brokers are upgrading their full year forecast for growth, and this adds to maybe the weight of the US recovery, which goes to offset some of the fears about whether we have a slowing China.
Which component would you pick up out of all of this data, which is most encouraging? I've been doing these interviews for many years now, and I was always told that always look out for construction PMIs, because that will always show you how confident people are in the economy, and that's been improving. But which part of these recent data sets would you look at as most important?
I'd agree, construction. I mean, it's got to be one of the longer term, it's an investment. You do not go and invest hundreds of millions if you're not confident of having a return on it. So to see that ticking up, although it is only a small component of GDP, it's a signal that people are prepared to put money on the line for seeing growth further down the line. Don't forget also the construction sector will also be helped to some extent by the new initiatives by the government to kickstart the housing sector, and that goes to increasing consumer sentiment, getting people confident to go out there and spend money. So we do have to be aware, is there a bubble being inflated? House prices have, they keep ticking up.
That's it, isn't it? It's funding for lending, isn't it? It's not real confidence, it's just something artificial that's being pumped in.
I think we have to be careful we don't have a rerun of getting house prices to levels which are extremely worrying. Then we start getting new initiatives to make sure they're still affordable, and then we're pushing the boundaries of loan to value and getting people in with far too little of a deposit and a cushion for negative equity. So it's good to see all these components improving. It's good to see so many things improving at the same time. It's interesting timing for the new Bank of England Governor, Mr. Carney. Some people do say that he's gone from one easy gig as he just arrived for another easy gig. The fact that they look to have changed voting away from QE and towards the forward guidance, on which we'll have more data tomorrow, is interesting, because it may well mean that we don't need more QE because things are taking off just at the right time for him.
The words forward guidance, those become very in vogue, just like tapering was a few months ago. What do you expect? What does forward guidance mean to you?
I'm not really sure anyone knows exactly what it means. I think it will be, rates will be low for a good while. I don't think they can afford to be as specific as for the next 2 years or something. That's just too much. But so long as we keep seeing that kind of language coming through, that should again ease sentiment that no one should be in trouble from a surprise rate hike. Although there is a recovery, the fact they're going to keep rates low to keep the recovery going. There's no point just switching things off and hiking rates and stifling the recovery. It's counterproductive. But as you say, the fact that it's become in vogue, that so many banks are using it, the Fed's adopting it, the ECB's adopting it, the key there is it doesn't really cost them anything. They're not having to print more money. They're not having to intervene. But it's a means of calming the markets and keeping things keeping things ticking over quite positively at the moment.
Turn our attention to equities. I know that's your area of speciality. If we are seeing some sort of recovery in the UK economy at least, is that filtering through to the results and to the earnings season, which we're in the middle of?
Earnings season was still a bit mixed rather. There were some misses, there were some good beats. It was still a mixed bag. We get a huge focus on the banks. It was good. The provisions weren't quite so high for mis-selling, although we had HSBC disappoint for other reasons on the provision front. Standard Chartered, it was a mixed reaction. Shares are doing quite nicely now. And of course we've got the rights issue by Barclays to bolster its balance sheet, to shore itself up in case there is another bit of weakness. So there have been quite a few things which maybe hide what's going on underneath. I mean, it's always tricky with banks because there's so many variables. It's difficult to pick out what is going on. But it was still a little bit mixed. You know, the US was a bit more positive. Europe was definitely mixed. And I think that's maybe visible in the fact that the markets, although they rallied hard into the summer, they have traded sideways since. We had a brief foray above on the FTSE last week, but we're back into that midsummer range. But I still see that things are moving in the right direction for a rally part two, if you like, for the second part of the year, unless we get some awful turn for the worse in data. Now, data, as we know, is very volatile. The big improvements we've seen may need a little bit of a tick back. Don't forget they are sentiment, so if sentiment does improve strongly, it's unlikely to improve as strongly the following months. We might see a tick back, but as long as we're seeing the PMIs above 50, retail sales still doing okay, inflation still cooling, I think that is sending things in the right direction. Although do bear in mind the FTSE has a lot of companies who've got nothing to do with the UK.
Well, thank you to Mike from Accendo Markets with his insights into the British economy and also the FTSE 100. Stay tuned to Dukascopy TV for more interviews, but for now, goodbye.